Exceptional developments in global stock markets this week again. The American index, the S&P 500, hitting another all-time high yesterday. Despite a wide range of arguments between the bears and the bulls, equity markets quite stable, and also the German stock exchange, despite the fact it's covered behind a crystal type cover for renovation, is also not far away from all-time high. Year to date, the American index is up 14%, and even the DAX not far behind, 11% plus. So what are the factors behind these quite stable developments? Well, looking at the economic situation, global PMIs since September have been improving and have been quite stable. The American PMI composite is at 54.7, which is quite an improvement, significantly above the 50% recession mark. But also the German's been improving, now above 52.4. So global sentiment, global PMIs are improving. That's astonishing given the fact that we've all been afraid of recession tendencies given the high interest rates. But what are central banks doing? Well, the Fed yesterday surprised with no decision. So they keep interest rates stable because they believe inflation is not coming down fast enough. That's despite the fact that US inflation CPI reported yesterday has been a positive surprise at 3.4%, coming down from 3.6%. Also core CPI with a similar tendency. So if you look at the inflation structure, it's improving, food is coming down, also prices for energy are quite stable, commodities actually with a negative development of minus 1.7% this month. So inflation picture is quite positive, and Jay Powell emphasized the fact that inflation tendencies are actually positive still, but he expects more improvements into next year. That's why he only announced one interest rate cut this year, which is throwing off the consensus. We've been expecting more interest rate cuts, up to 3 interest rate cuts this year. So the consensus discussing the Fed is thrown off. We've been discussing the Fed for years now, and the Fed itself, the dot plots, are indicating 3 to 4 interest rate cuts now next year. That is a surprise, but how are markets reacting? Well, they don't seem to care because expectations are still there, and the market obviously, kind of like the equity market, loves uncertainty, loves doubts, and is working along this doubts into the next year. Probably the fact is it can hold quite well as long as we have these doubts on the Fed policy. In contrast, the European Central Bank has been quite brave this year, announcing an interest rate cut even before the Fed does it. So that pattern is also new to markets. The ECB not following in the Fed, it's probably the other way around this year. So what do we make out of that in terms of strategy on a global basis? With the PMIs stable, with earnings expectations reaching 10% again into the next year and also for this year, we probably have to hang in there for a while in risky assets, despite the fact that sentiment has improved, but sentiment measured as by the AA sentiment index has not reached a very extreme. So hang in there, keep positions in equity markets, climb the wall of worry and wait for the Fed to confirm the first interest rate cut. Probably volatility will only increase once the Fed confirms that move. In Germany, we're playing catch up, so 11% this year is also quite a good return. We have a different constellation because manufacturing in Germany is weak, but maybe if the US keeps stable, we can follow and also reach another all-time high quite shortly in the DAX index.